Double bottom pattern, the W that sparks a bull run. The double bottom is a powerful bullish reversal chart pattern that forms after a downtrend, signaling a potential shift from bearish to bullish momentum. It looks like the letter W, where the market tests a strong support level twice, but fails to break below it. This repeated rejection shows that sellers are losing strength and buyers are ready to take control. Structure of the pattern. 1. First bottom, price falls and hits a key support level. 2. Pullback. A temporary bounce forms a moderate peak neckline. 3. Second bottom, price again tests the same support zone but holds strong. 4. Breakout. A decisive move above the neckline confirms the bullish reversal. Trading insight. Aggressive traders may enter near the second bottom with confirmation from bullish candles or indicators. Conservative traders wait for a breakout and retest of the neckline. This confirms buyer strength and increases reliability. The target is typically measured by the distance between the bottoms and neckline, projected upward from the breakout point. Study insight. According to a 2022 study by Smith, Analyzing Bullish Reversal Patterns in Financial Markets, Institute of Financial Studies, double bottom patterns show nearly a 70% success rate in predicting bullish reversals. Pro tip: always look for a volume spike during the breakout above the neckline. It confirms that real buyers are stepping in. If the breakout happens with low volume, the move might be weak or false. Combine this pattern with indicators like RSI divergence or MACD crossover for even higher accuracy in your trades. If you found this video helpful and learned something new, make sure to like, comment and subscribe to our channel, ToDo TradeCast, where we bring you smart trading concepts, price action secrets and real market examples. Stay smart, stay profitable with ToDo TradeCast.